Now then, guys, this is the second video. It's about investing and compound interest. As we know from the last video, if we're investing, we want to go into a market and we want to buy something low, and gradually we want to keep it in over time, or we want to sell it high and realize some of those profits. We can sell a load off, or we can just shave some off gradually over time, which is usually a good strategy, just because we don't know when the actual high is going to be and if we're going to make any more profits. Yeah, so that's pretty much it. We're buying things what we think are going to go up in value. So we know that. So if we can't buy low, what we are usually better off doing is just saving our money and waiting for an opportune time to strike, rather than just buying high and riding drawdown, because obviously we're losing money. So we might have to wait through a 55% drawdown if we bought some Tesla high here, for example, even though it's good, even though it's probably going to take over the world, until it bounces off its order block, likely here, or just takes it and moves up. Yeah, you might be waiting years before it returns to where you bought it from. So a much better alternative would be to actually save the money, buy some when it's hitting around here, and I can help you with all these sort of things. You'll sort of get these as you go through, and you can ride your 122 buy and start scaling out when you've doubled your money, when you've tripled your money. Yeah, and coming back to the high there, I'd rather be tripling my money rather than waiting through an 80% drawdown, sweating, giving the markets my hard-earned money. But usually you don't want to sell at a loss. You usually want to keep it in and believe in the thing you're buying. So that's that. Usually what you want to do is buy assets which have lost value due to market conditions, i.e. just the general state of the market, and are likely to return. So if we looked at a, so the S&P 500, SPX, and if we looked at, this is the index fund of the stock market of the top 500 stocks, I think, in the USA. I'm not an actual expert on these, but I do buy bits and bobs. And in the dot-com boom, when all the sort of computing and things were coming out, and then there's the crash there. We've had a crash there of 50% during the 2008 financial crisis. The housing market crash, the Lehman Brothers, all that. If you watch the film The Big Short, you can see some of that. Again, the 50% drawdown, and where we are here, and expecting some more drawdown, you know, 20%. We could come all the way down to around here in the lows when the virus come out. Yeah, so you'd be better off waiting and buying down here and riding the gains up than you would just completely buying like that. But having said that, you can see the shape of this chart. The stock market over time goes up. You just don't want to be one of the arseholes who buys high and has to wait 4 years for it to return. Yeah, or whatever amount of years. I'd rather just save, buy a crash. Save, buy a dip. Save, buy a dip. Yeah, and you're going to be making a hell of a lot more money. Over time, I forget the exact number, because this isn't actually something I do, but I know it's something you can do, and a lot of people do, and I will be waiting for a correction to actually go in with some stocks, and this is what I'm waiting for. Just some slow money on the side rather than me sat in the bank. But the power of compound interest. So basically, as you buy something, and let's say it's 10% a year, what it averages, it goes up, you know. So from 2000, the year 2000 here, up to the year 2020, which was up here, yeah, we've more than doubled. We've like tripled, whatever, even then some. Yeah, nearly tripled what it's increased by. So we say this is 10% a year. You know, people say 7%, 10%, 5 to 10% a year on average. If you put in £1,000 to start, and every month you could shuffle in 500, and on average, it was increasing by 10% yearly, which on an average it does. Over 20 years, if you put that in, you would have deposited that much, and the interest would have actually started to snowball and be more than you actually put in, because you're making interest on your interest. This is the power of compounding over time. So if you've got a young kid who can earn some cash flow, a real good way for them to be a millionaire is just to shuffle as much money into an index fund as they can for about 20 years. And most kids will be a millionaire by the time they're 40. So it's like get rich slow. I'd recommend you have a look at this. I'll put this in the description as well, and you can play about with it. But you can see over a time you've put this much in, and the interest to start to actually take over around this point here, around the year 14. So it takes some time, but it does. So if you did it for another 10 years, you'd be laughing your head off. So if we put that for 30 years, no one wants to get rich slow, but let's just say you do. You've put in 180 grand and you've got 800,000 and odd in the interest there. So this is the power of compounding. For me personally, what I'm looking to do is cash flow. So we're going to go a little bit back. You want something what earns you good cash flow, where you can invest into something passive. So it's like people saving up, buying and flipping properties, buying and flipping houses. It's a similar thing to trading, but it's a lot less liquid. Like you can't just sell a house tomorrow, but trading, you can get your funds in and out within minutes sometimes. You know, it's a lot less reliant on the market conditions. It's just something I prefer, and I'm actually confident in my own trading. So I'm looking just to shuffle money into my trading pots, and that's my life plan, pretty much. Money through different means, and then shuffle into trading pots to put up against leverage to bet on markets. So these stock indexes, we've gone through that, power of compounding, strategies, and my personal strategy. This is what I will say a little bit. Generally, if you're going to buy index funds, you want more money in larger and more proven assets. So say you could put 10k into something a year. You might put 5 into your index funds or more, and this is where like financial advisor or whoever comes in. I'm not a financial advisor. And then you might put 1 into different stocks you like. So you could put some in Amazon or something you're expecting to outperform this. You might get 2 what devalue, or you might get 3 what up 40% each. So on average, you make quite a bit more from these 3 than you do all the rest of the stuff. But this is more set, the 5 grand in the index funds, and the smaller amounts go into the more risky investments. If you're going into all in on the risky investments, it's more likely you'll actually lose. And the old saying is from Warren Buffett is it's time in the markets, not being stupid, not acting stupidly. It's all that stupid. It's more important than timing the exact market. So they get rich slow. I like to disagree with that a little bit. I like to imagine I'm trying to do both as best I can. So money, cash flow goes into things, and that moves up over time, and it beats the rate of inflation, what's basically robbing you of your spending power. And it's fairly liquid. So this is why I like markets. Okay, boom, video 2 done.